My name is Roger Leaning. I'm a director in the corporate advisory team at Morgans Financial. Thank you for your time and interest, and I hope you and your loved ones are healthy and safe. Working in stock markets means you are no stranger to change, which means you learn to view change a little differently. During periods of rapid change, it is important to share and constructively challenge views on potential outcomes. So with this in mind, I'd like to thank the team at Collins, Biggar and Paisley for the opportunity to share our views on capital raising pathways for exploration and development companies during this period of heightened uncertainty. However, I first need to make note this presentation is for general information purposes only and not intended as an offer of services or to enter into a transaction. Please note these are just our views, so please seek your own professional advice. So on to the introduction. Look, over the next 10 minutes or so, I will briefly reflect and provide some observations on equity markets, discuss the need to target specific investors when considering a capital raising, and outline who these potential target groups are. Then we'll go on to present on how to present your business in order to attract the attention of some of these target groups. And then finally, I'll provide a brief overview of some potential offer structures. The chart on page 4 attempts to illustrate the relationship between large and small companies, and more specifically, the ASX 200 large and small resources indices. The chart tracks respective indices from a common base. In this instance, the common base is April 2018. Observing the divergence or convergence of respective indices in conjunction with other qualitative and quantitative analysis can often be a useful indicator of risk appetite, which in itself we find useful when considering an appropriate target audience when trying to raise awareness and attract interest into a particular sector, commodity, or company. Some high-level observations from this chart include during the pre-COVID or pre-COVID-19, we were still largely in a risk-off environment, which of course, when it comes to attracting investors, adversely affects high-risk companies such as explorers and developers. However, towards the end of the calendar year 2019, there were signs that risk appetite was improving. The global impact of COVID-19 to financial markets is clear in this chart. However, the global economic impact is not. I don't think there is any doubt that economies and markets will recover. However, there will be significant changes to both supply and demand side market dynamics. For example, what and how we consume, purchasing behaviours, and significant changes to supply chains, all of which are very difficult to predict and complex. Complexity typically creates uncertainty, and uncertainty leads to share market volatility. Supply-demand rebalancing will take some time, and as such, share market volatility will likely persist. However, the substantial quantitative easing policies adopted globally are aimed at increasing economic and financial market liquidity and in turn mitigate volatility. Hence, these policies are critical to the speed and shape of our share market recovery. At the present time, we would describe share market sentiment to be cautious but opportunistic. Indiscriminate sell-offs have and will continue to create investment opportunities. These opportunities are prevalent across all sectors. So effectively, in the near to mid-term, risk-seeking investors do not need to go further than the ASX top 50 with a view to achieving superior returns. In other words, investors do not currently need to go up the risk curve. This is also one of the reasons why we believe large caps will lead a stock market recovery, and the large and small indices as highlighted in this chart will again diverge in the near to mid-term. Some market commentators predict that the resource sector will lead a share market recovery, basing this view on an increase in consumption in any shape or form will require an increase in commodity consumption. And China is a large consumer of commodities and has been one of the first to emerge from a post-COVID environment. Although we agree with the sentiment of this view, specifically towards large resource companies, we think this is relevant. However, we note that this potentially underestimates the changes to supply side dynamics. In our view, post-COVID supply-demand balances of individual commodities will take time to reset, which may lead to ongoing price uncertainty. On to slide 5. This chart summarised the small and medium resource capital raising activity over the past 5 years. We believe this chart supports our view that for some years now, the market in general has been risk averse, meaning that the cost of capital for small resources sector has been high. We also believe it supports our view that towards the end of last calendar year, there was an increase in risk appetite. However, it is evident that the investor focus has most certainly been in the large cap end of the market and ex-resources. To illustrate this point, compare the peak activity experienced in the small to mid resources sector, which is the third quarter in 2019, to the number and value of COVID-19 recapitalisation transactions undertaken across the entire market over the last month. In the 3 months from July to September 2019, there were approximately 135 transactions raising just over $1 billion in the small to mid-cap resource sector. Over the past month, there have been just over 40 transactions across the entire ASX, raising over $11 billion, the vast majority of which in the large cap space, and this number is growing as we speak. In summary, at present investors are cautious but opportunistic, and focus is most certainly towards the rewards on offer at the larger end of the market. So on to slide 6, what does this mean? Or does this mean the door is shut for small resource capital raisings? In short, no, but you do need to target your audience. Looking at who participated in previous transactions can be informative, but difficult to ascertain due to confidentiality and sensitivities. The graphic on page 6 highlights a number of investor types, each of whom will carry investment expectations and requirements. To achieve a successful outcome, it is critical to align company and investor expectations. As such, in our view, it is important to objectively and honestly assess your current status, situation, and requirements, and then realistically marry these to the investor group that will most likely offer a funding source. The reality is there will initially be a difference in view on the perceived risk of the investment opportunity between you and the target investor, which will be a function of relative understanding, access to information, inherent biases, which will then translate into value. To minimize the pain and time of successfully acquiring funding, you will need to be realistic in determining the appropriate target audience. And without doubt, in an environment where competition for capital is very high, some compromise with respect to funding terms and conditions will be necessary. For listed companies, the pool of traditional investor groups is institutions, high net worths, and more risk-seeking retail investors. And this group continues to change and shrink, which is due to ever-changing economic and market conditions, and in part increased awareness of environmental and sustainability issues, and the growth of ethical investing. This in itself is a separate topic which we don't have time to discuss today. Suffice to say, don't underestimate the value of having an ESG strategy. More pertinent to this discussion is that this has led to the emergence of specialist resource funds, including private equity, and increased reliance on direct investment from high net worths. These are both professional and sophisticated investor groups who typically have a deeper understanding of the resource exploration and development sectors and associated risks, and more often than not, willing to take a longer investment time horizon. In the current environment, this target market is even narrower and is primarily restricted to existing shareholders and possibly specialist funds or high net worths that you've previously been talking to and show a real interest. Within this target group, identify potential deal leaders with whom you can walk across, develop, and agree a deal construct. Don't forget or ignore your broader shareholder base, but in the current environment, it is imperative you generate deal momentum. Remember, competition for capital is very high, so you will need to stand out amongst the crowd. Which brings us to page 7. How do you stand out amongst the crowd? Well, the slide here on page 7 provides a bit of a checklist, which is not exhaustive, but it's a checklist of things investors will typically focus on. However, we do note that standing out in a crowd is not a box-ticking exercise. In short, you will need to describe the opportunity, what the prospectivity of the assets in the project are, and why it should be of interest. You'll also need to demonstrate an ability to execute. This primarily relates to the experience, capability, and track record of the business and its key staff. Now, this is typically considered a key determinant by many investors. Clearly articulate the value proposition of the company, its assets, and capital raising offer. What is it? Why is the opportunity too good to miss? Once you've identified and attracted interest, then the discussion will often turn to structure. Turning to slide 8. In the interests of time, I'm going to focus on typical listed company deal structure requirements. Unlisted or private company offer structure may be limited by the company structure, and typically the audience will be very different. Please ensure you are familiar with recent temporary changes to the listing rule amendments, which are aimed at ensuring some fairness to all shareholders with respect to prospective capital raises. These have been developed primarily with large cap companies in mind. Again, this is a topic for another conversation, but suffice to say, you should consider your entire shareholder base and not just focus on a quick solution to an immediate problem. Anyway, fundamentally, for listed companies, there are 3 offer structures to consider. A direct placement of shares to sophisticated investors, which entails institutions or high net worths. This is typically the most efficient, time efficient and cost effective capital raise, but can be dilutionary to existing shareholders who are not able to participate. A share purchase plan, which offers all existing shareholders the opportunity to invest up to $30,000 in new shares. This allows all shareholders to participate, as I noted, but takes longer, around 3 to 4 weeks from announcement, and if not underwritten, the outcome can be uncertain. An entitlement offer or rights issue provides existing shareholders the opportunity to acquire new stock on a pro rata basis. It typically takes between 3 to 5 weeks to complete from announcement, but is seen as the most equitable raise. But again, if not underwritten, can provide uncertainty with respect to outcome. In reality, share purchase plans and rights issues are often accompany a placement, which can help facilitate an underwriting, which can remove some of that uncertainty around the outcome. The appropriate capital raising structure should be determined with reference to the objectives of the company. Some of these determinants are listed on page 8, as are some of the offer pricing considerations, which I'll leave you to consider further. So in closing, understand your environment and current investor sentiment. Know your audience, which effectively means develop long-term relationships. Clearly articulate your value proposition. What is it? Will others value it? Can you describe it? And can you document it? Manage and deliver on expectations. This is essential to develop a track record and be in a position to make subsequent raises when needed. Share the vision. Align the company and shareholder objectives. And plan your capital raise strategy well ahead of your capital requirement. Again, thank you for your time. Please stay well and safe.
To introduce myself, my name is Brent van Staden. I'm a partner in the capital markets team at Colin Biggers & Paisley. We've been advising mineral explorers and developers for many years now, and I've been part of the team since 2006 when we commenced work on the Orocobre IPO. There have been many since then. I welcome you to our first virtual resources think tank and thank Roger for his presentation. I know that he's addressed issues of great concern and of perennial concern to explorers and developers, namely accessing cash, given the business model that these entities have. Linking with Roger's presentation, I'd like to talk to you today about raising capital as a small ASX listed company with special reference to ASX listing rule relief to assist capital raising in the current difficulties in the market, whilst also minimizing exposure to risk. I'd also encourage you to send any questions you may have about the ASX listing rules, raising capital generally, or any other corporate law questions to us, as we'd like to answer them in future presentations. Looking at an outline of what I'd like to talk to you today about, the topics we'll address are firstly, capital raising options, matters which Roger has already touched on. Then taking an overview of placements, an overview of rights issues, and an overview of share purchase plans. After that, I'd like to talk to you in a bit more detail about placements, namely advantages associated with them, housekeeping, regulatory issues, and COVID-19 relief. And in relation to a bit more detail on rights issues, the basics about rights issues, structuring choices, some information about accelerated rights issues, and issues with low doc versus prospectus-based offers. I'll then talk to you a little bit about cleansing notices and some issues associated with them, as they are critical to low doc offers. And then finally, some COVID-19 relief and fairness to investor issues that have arisen in recent times in the context of some fairly recent capital raisings. In terms of capital raising options, as Roger mentioned, the primary pathways for listed developers and explorers in the mineral sector to raise capital are placements, entitlement issues or rights issues, and share purchase plans. Less relevant, but sometimes are used, and for the sake of completeness, I'll make mention of secondary listings on exchanges like the TSX, but I think they would form the subject of a separate presentation in the future. Taking an overview of placements, they may be defined as an issue or an offer of securities directly to identified investors, rather than an offer to a class of investors as with other types of capital raising. While typically involving shares, they may also include options, convertible notes, and other types of securities. Placements can be underwritten, but usually are not. And whether or not underwriting occurs depends on whether investors have already been identified at the outset, or whether you're asking a broker to go out and place shares. Taking an overview of rights issues, sometimes called entitlement issues. They are offers of shares to existing shareholders, pro rata to their existing holdings. That said, there are some deviations from that, which I'll address later on in this presentation. Taking a quick overview of share purchase plans, broadly, they share attributes with rights issues in that the offers are pro rata to existing shareholders. But in this instance, entitlements are capped at 30K per shareholder over every 12-month period. As a result, some companies run annual SPPs, and you can see how larger shareholders might be prejudiced because of the 30K cap. A perceived advantage of SPPs is that no prospectus is needed and costs are therefore low. However, there are some regulatory restrictions under the ASX listing rules that I'll refer to later in the presentation. In terms of regulatory requirements, also ASIC does impose some content requirements for offer documents used in relation to an SPP. And you'll see later the company needs to lodge a cleansing notice under the offer. I'll talk more about cleansing notices a bit later. Looking now at placements in more detail, it's obvious that they offer the quickest pathway to raise cash and can be valuable as a tool in bringing in strategic investors to your register. Typically, no prospectus is needed because the offers are almost exclusively made to sophisticated or professional investors. Also, there's no direct legal regulation on pricing, but I think as Roger alluded to earlier, and as you might have seen in recent press releases about very dilutive placements and capital raisings, this is moderated by the dilutionary impact that the placement would have on shareholders. For that reason, we urge directors to articulate very clearly their pricing narrative, because at some point people may ask questions and you need to be able to answer them in a coherent manner. Of course, the dilutionary impact is often softened by linking the placement to either a rights issue or an SPP, and you'll see later that this is recognised in ASX's COVID-19 measures. Placements can be made to one or more investors at one time, usually sourced from, in this industry anyway, the director's own network, or sometimes through a broker or financial advisory firm. As I mentioned, in the latter cases, underwriting sometimes is an element. And on that point, where underwriting is involved, a whole range of regulatory issues relating to control and Chapter 6 of the Corporations Act can arise, whilst there are exemptions. If you look at takeovers panel cases over the last 10 years, you'll note that exploration companies are certainly well represented there. As a matter of fact, we've represented companies in that panel several times. Placements involve elements of risk, as do all offers of shares. It's wise to ensure that they are properly documented and that marketing presentations, placement agreements, broker mandates, and underwriting agreements are drafted with an appropriate allocation of risk. Of course, it's critical to ensure that D&O cover is adequate and responsive at any time as well. On the regulatory side, placements are covered by multiple provisions in the Corporations Act and the listing rules, including ensuring that investors qualify as sophisticated, and as I'll address shortly, disclosure is up to date. I've seen many instances where placements through director networks have not been accompanied by the certification certificates that are needed for sophisticated investors who are investing less than $500,000. That is a critical requirement, and we always remind clients to ensure that those are on file. Relevant listing rules include, obviously, most importantly, listing rule 7.1 and your 15% issue capacity, but also listing rule 3.1, dealing with continuous disclosure and related confidentiality issues. There are also important Corps Act provisions relating to cleansing notices, Chapter 2E related party rules, and sometimes Chapter 6 takeover issues. In relation to placements, ASX has implemented measures to assist with capital raising during the COVID-19 crisis, some of which has been recently used to raise literally billions of dollars and attracted a lot of media attention, some of it quite negative. The listing rule 7.1 issue capacity has been increased by ASX from 15 to 25%, although some companies already have an additional 10% under listing rule 7.1A and therefore can't access this additional listing rule capacity. To obtain this placement relief, the placement must be followed immediately by a non-renounceable rights issue, either traditional or accelerated, or an SPP, in either case at the same price as the placement. Take note that the relief is once off only and can only be utilised in a single transaction. It cannot therefore be replenished under listing rule 7.4 and utilised again. At the same time, ASIC has intervened by raising the maximum days of trading suspension from 5 to 10 before a company is barred from issuing a cleansing notice, which is needed for a placement, a low doc rights issue, and SPPs. It's really key, and many of you will know that exceeding the 5-day suspension limit as an explorer is not altogether unusual. What usually happens when you've exceeded the 5-day limit is you can't issue a cleansing notice, and therefore, in order to undertake a placement, you need to issue a cleansing prospectus, which is a lot more difficult in terms of time and costs, although we have done many of those in recent times. So ASIC lifting the cap from 5 to 10 trading days of suspension of your securities while still being able to cleanse with a cleansing notice is quite valuable and useful at this time. Bear in mind that the placement relief I've spoken to now, that is the additional 10% of issue capacity, links with relief pertaining to rights issues and SPPs that I'll address shortly. Looking in more detail at rights issues, they can be divided between traditional and accelerated, in each case renounceable, non-renounceable. For renounceable rights issues, shareholders can sell entitlements instead of taking them up, and with non-renounceable rights issues, untaken entitlements lapse, although they can be picked up under a shortfall facility. ASX capital raising relief is aimed primarily now at non-renounceable offers. In relation to rights issues, pricing is usually fixed, although one can use a book build to discover the price in some cases. And in fact, one of our clients outside of the resource sector is about to do this. But this is uncommon for explorers and developers. Rights issues can be structured with ability for shareholders to take more than their entitlements and shares if there is a shortfall facility set up and the documents are properly structured. Directors can also place untaken shortfall shares, in either case without utilising issue capacity under listing rule 7.1 or 7.1A. But for this to be available, the document needs to be well drafted and to make these available options clear to investors. If not properly drafted, these options are not available. Considering differences between traditional and accelerated rights issues, a key feature of traditional rights issues, which incidentally avoids use of the 7.1 issue capacity and in fact some takeovers restrictions, is that offers are the same for all shareholders in terms of price and timing. If these are not the same, generally speaking, placing the shortfall can breach takeover's requirements, and in fact, the rights issue itself is subject to takeover's requirements, which could prevent shareholders from taking up their entitlements. So therefore, it's important in traditional rights issues to make sure that all offers to shareholders are the same in terms of price, time, and security. However, accelerated rights issues allow us to fast-track entitlements taken up by institutional shareholders well before retail shareholders take up their entitlements. This means quicker access to cash, either where working capital is needed or where funds are being raised to complete a transaction. Using this pathway still preserves placement capacity under 7.1 and falls under takeovers rule exceptions. I've mentioned a few times the concept of institutional shareholders with reference to accelerated rights issues. Note that the concept is not exactly the same as sophisticated investors. If properly drafted, the offer documents can leave room for the company to decide who will benefit from an accelerated offer. Not all sophisticated investors are necessarily able to participate. However, of course, this can be abused and has been the subject of dispute. As a matter of fact, the statement of the law on this issue was in a recent Deutsche Bank case. Just another point on rights issues. Usually rights issues under the ASX listing rules cannot offer more than one share for every share held. This prevents rights issues from creating large shortfalls that can be abused and are dilutionary. However, ASX COVID-19 relief has relaxed this cap, and in fact, at the moment, there is no cap under the relief. This therefore allows for rights issues that could generate large shortfalls available either for take-up by other shareholders or for placement. That said, the Takeovers Panel has impugned many rights issues that they consider have been structured specifically to generate this result. I think at the current time, when there's been adverse press coverage of a number of highly diluted rights issues resulting in very significant shortfalls are likely to be rigorously scrutinized. Turning back to SPPs for a minute, I mentioned that there were some restrictions imposed under the listing rules. Firstly, generally, the number of shares issued under an SPP can't exceed 30% of all shares on issue, and the issue price is based on an 80% VWAP, and therefore obviously is required to be at a discount. However, under the ASX COVID-19 relief, the 30% cap and the VWAP pricing restrictions have been removed. As a result, pricing is now aligned with the preceding placement if you are using the ASX temporary relief. I think the use of ASX COVID-19 measures in recent times has renewed interest in accelerated rights issues. Initially, traditional rights issues were actually excluded from the COVID-19 relief until late April, when the ASX made an amendment to the relief to include them. Accelerated rights issues are conducted on a low doc basis, typically without a prospectus. This is believed to offer a time and cost saving, and that may be correct. However, it is very important to understand that the use of low doc pathways means that a cleansing notice is issued as part of the offer process. I'll explain exactly what cleansing notices say shortly, but most importantly, it should be noted that where no prospectus is used, there is no due diligence defense if things go wrong. This means that any deficiency in disclosure that misleads or deceives investors gives rise to liability on the part of the company and potentially also the directors. Even an honest mistake that a reasonable person could easily make in the circumstances has no due diligence defense. I recall an instance recently where a tenement overseas was lost because a local agent made a mistake in relation to renewal processes. If that tenement was material, under due diligence defenses, there would most likely be a defense if shareholders sued directors for failure to disclose the loss of the tenement. However, under a low doc offer, arguably, there is no defense that the directors can raise in relation to those claims. At most, they could look to sue the agent in the foreign jurisdiction, which is not an ideal solution. This brings me to the issue of cleansing notices. Many of you are probably familiar with them as a document that your COSEC generates from a template. Few people put much thought into them, in my experience, especially in the small cap sector. In the cleansing notice, the company tells the world that its previous announcements are up to date, correct, and not misleading. If there is a mistake, for example, with the lost tenement, liability arises and there is no due diligence defense. But more importantly, many of you would also be familiar with exceptions to Listing Rule 3.1a, usually for matters that are confidential or incomplete proposals. Those exceptions form some of the most critical and contentious listing rules, and also the basis of many class action lawsuits. A cleansing notice must include information that is excluded information. Excluded information is information not previously released on the ASX because of one of those 3.1a exceptions. But for the purposes of cleansing notice, which investors and their professional advisors would reasonably require to be disclosed and expect to see in a prospectus, to make an informed assessment of the assets, liabilities, financial position and performance, profits and losses, and prospects of the issuing company. If you look at Section 710 of the Corporations Act, which sets out the standard for a full IPO prospectus, the words are exactly the same. You therefore need to put this information through the full prospectus paradigm, but at the same time, there's no quid pro quo due diligence defense if things go wrong. You can therefore see that a cleansing notice poses a lot more risk than a lot of people anticipate. Using a short form prospectus for a rights issue has some distinct advantages, notably existence of the due diligence defense and no need for use of a cleansing notice. For listed companies, the short form prospectus is used, which is quite a simple document and which is not much more complex than the current consensus regarding offer documents in low doc rights issues, and in fact, all low doc issues. The due diligence defense availability materially reduces legal risk associated with an offer of shares, and I would urge directors to have careful regard to differences in cost and time versus the benefits that may be obtained by using a short form prospectus instead of low doc pathways for capital raising. You should also note that it is not necessary to use the low doc pathways in order to access the ASX COVID-19 relief. Certainly, if you're going to use the low doc pathway, there are measures you can take to reduce risk. The most important of those is to cross-examine your continuous disclosure regime, conduct a dialogue with management, particularly those that are not represented on the board, such as field geologists, etc. Very importantly, engage appropriate expert advisors, legal, accounting, technical, geological, as appropriate. And finally, just because you might not be using a prospectus doesn't mean that you shouldn't undertake a line-by-line review and verification of materials that are going to be publicly released. This certainly would go a long way to mitigating the risk represented by the absence of a due diligence defense. Recent press releases over deeply discounted, highly dilutive rights issues and placements under the ASX COVID-19 measures have attracted negative attention, in fact, quite considerable negative attention, and have raised the issue of fairness. Certainly some of the reporting has been quite over the top on that. Speaking of, for example, investment bankers gorging themselves on discounted shares. As a result, around 20 April, ASX updated its guidance on this relief so that reasons for raisings making use of the relief must be given to the ASX before they commence, explaining both the company's position and rationale. Also, very importantly, in relation to allocations, companies must now announce on the ASX details of the approach taken to identify and make allocations to placement investors. Interestingly also, the companies must supply a detailed spreadsheet on allocations to both ASIC and the ASX, setting out full details of the placement investors and the number of securities that were allocated. This ties in with what I mentioned at the outset, that it's very important to articulate a capital raising and pricing and allocation narrative in the board papers preceding the rights issue or whatever other raising has been undertaken, so that there is a coherent story and narrative underlying it. This aligns with ASIC's interest in allocation policies since about 2016, initially focusing on broker allocation methods, but now raising the bar to look directly into companies as well. I'm certain that disputes based on public information are going to arise in relation to allocation policies in the near future. And I would certainly not want to give ASIC that spreadsheet unless I knew that it showed a fair and defensible allocation strategy. Bear in mind the detail has to be granular under ASIC guidance. You should also note that ASIC has stated quite clearly that it regards the allocation issue as a fiduciary duty issue to shareholders. I think that's shot across the bows, to be honest. Just other issues to take a note of in the capital raising environment we face now with COVID-19 is that underwriting agreements are likely to contain quite aggressive market fall clauses, and those are going to be quite aggressively negotiated. Another important thing to remember is that the liability regime underpinning all capital raisings, most particularly those that are low doc, remains the same. There is no special treatment being allocated to companies raising capital in the current environment. As a matter of fact, ASX releases and guidance relating to COVID-19 place quite onerous obligations on companies to, in a careful and considered manner, look at their position and the likely impact that the current situation is having on them and make sure that investors are appropriately informed. Just looking briefly at presentations we plan to look at in the future, we've listed a couple of topics there. We'd be interested in your feedback on any of those that might be of interest to move up the list first. In conclusion, we've all experienced an unprecedented event in 2020. Regulators have responded by lifting some restrictions on placements, pro rata issues, SPPs, and the availability of low doc offer pathways. I think that given uncertainty about the future and the impact of recent events on your company that may not yet be fully apparent, while it's logical, especially for explorers and developers, to make use of these windows, to do so with a clear view of how to protect your company from risk is something that we urge. Get the right people around you. We've been in the trenches with clients for more than 20 years in this space. Feel free to contact us if you have any questions or would like to know more. I'd like to thank you all very much for attending our first virtual think tank. I hope to hear from you and do many more in the near future. In the meantime, stay safe.